Good morning, everyone. I'd like to start off by thanking the Intertribal Timber Council for inviting me to present to you today. I've been asked to provide an economic market update for this year's Timber Symposium. My focus is rather narrow, concentrating on more direct economic drivers of timber and timberland values. My presentation is largely derived from material that I prepare each quarter and provide to my current and prospective consulting clients. Going forward, I will be sending a copy to Laura Alvarez, and she will post the documents on the ITC's website on the publication and resource page under market information. You'll be able to find today's presentation material and my first quarter market trends on the ITC website. Please consider these disclaimers as I go through the presentation. While I feel confident about the accuracy of the materials I've put together, as with most things in life, there are no guarantees. That said, I hope you find this material interesting and useful as you chart your path forward in the coming year. I'll begin today's presentation with an overview of some key housing market indicators, followed by housing starts and home sales. I'll then discuss the long-term and recent trends in softwood product prices and log prices in the U.S. I'll draw the presentation to a close with the discussion of timberland values and timber earnings. At that point, the lines will be open for a question and answer session. Let's get started. Here on slide 4, these two charts depict builder sentiment and residential expenditures over the past 2 decades. Home construction expenditures and residential improvement expenditures, also known as repair and remodeling, are the two primary wood-consuming sectors of the economy, making up about 70% of solid wood products used in the U.S. As such, they are key drivers that ultimately affect timber demand and timber prices. First, let's make sure everyone is familiar with what we're looking at. The National Association of Home Builders, or NAHB, publishes the Home Builder Market Index, HMI, and the Remodeling Market Index, RMI, depicted on both charts by the red and blue lines. These indices are measures of home builder and remodeling contractor sentiment. The monthly home builder and quarterly remodeler indices measure the proportion of survey respondents who have a positive versus negative view of their respective industries. A reading over 50 indicates that there are more positive views of current and future conditions than negative views. Neutral views are ignored. The green areas on both charts show the U.S. Census Bureau's tally of monthly construction expenditures and then adjust them to a seasonally adjusted annual rate, or SAAR, and I've taken the Census Bureau's figures and adjusted them to take out the effects of inflation over time. So the figures you see here are in constant or real 2020 dollars. Let's look at the trends. During the second quarter of 2020, when the economy was locked down due to the onset of the COVID-19 pandemic, you can see that both builder sentiment indices took a sharp nosedive. These declines were almost immediately reversed when construction was designated as an essential industry. Over the last 3 quarters, builder sentiment has hit all-time highs for both new construction and remodeling expenditures. While builder sentiment declined last year, expenditures barely slowed, and over the course of the past 11 months has really accelerated. Private expenditures on single-family home construction increased 10% in 2020 over 2019, while private spending on residential improvements increased 18% last year. Higher material and labor costs impacted both sectors, but it was really the added improvement activity by homeowners that drove expenditure numbers so much higher. More time working and schooling at home drove some of the increase, while household financial resources were redirected from vacations to home improvements during the pandemic. I think that seeing these sentiment indicators in relation to the amount of money actually spent on construction is informative. The single-family construction, you can see that from 2013 to 2018, builder sentiment has been around the same level as it was back in the early 2000s, when housing expenditures were much, much higher. Stronger or declining builder sentiment provides a directional indicator of near-term construction expenditure trends, maybe 6 to 12 months out, but not the absolute number of dollars to be spent. The residential improvements, it's unfortunate that NAHB changed their survey methodology just as the pandemic was getting started. So it's unclear how much higher remodeler sentiment is today versus years past. The new index is in blue, the old index is the red line. For residential improvements, the linkage between contractor sentiment and near-term dollar expenditures appears to be weaker. As I just mentioned, the RMI and HMI reflect builder sentiment for the next 6 to 12 months, so things are certainly looking good in the near term. Longer term, construction expenditures should see slower growth as building material prices retreat from record highs and the housing market regains some pre-pandemic normalcy. A recent article from NAHB estimates that higher building costs have added $36,000 to the cost of a new home. As we will see later, constrained supply of existing homes, limited supply of developed lots, and higher labor costs caused by scarce labor and contractor availability will likely keep residential construction and improvement expenditures elevated for a while. On page 5, I provided some explanatory notes for the previous slide that you can refer back to after today's presentation. In addition, I've also included a chart that contrasts the rate of inflation for the US economy in general, the Consumer Price Index, or CPI, depicted by the red line, against the Single-Family Price Index for construction costs, the blue line. The Single-Family Construction Price Index accounts not only for the total cost of construction labor, materials, and lots, but also adjusts these costs by the average size of the home constructed. What this chart shows is that for almost an entire decade now, since 2012, the cost of home construction has risen at a pace more than 3 times faster than the broader basket of goods represented by CPI. Such a long duration of steep price increases hasn't been seen before, at least going back to 1985. On slide 6, the blue line reflects the National Association of Realtors, or NAR, Housing Affordability Index, which reflects the affordability of existing homes. Also included is my index of new home affordability, the red diamonds. For both affordability indices, we are currently sitting at rather elevated levels, historically speaking. Both indices are based on either median existing or new home prices, mortgage rates, and median family incomes, which will be discussed in more detail on the next slide. While the affordability indices here look promising for continued housing demand, it is important to recognize that the linkage between affordability and housing starts is rather weak. Demand for housing tends to be driven more by underlying demographics, which are improving, and the desire of American households to own a home rather than rent or live with mom and dad. This desire to own a home has been improving over the past few years and accelerated during the pandemic, but home ownership remains well below 2006 peak. It remains to be seen how long this heightened desire for owning a home persists once the pandemic ends and work and school patterns return to normal. During the housing boom of the early 2000s, affordability was actually quite low, up until the mortgage-led Great Recession of 2007 to 2009. Loose credit for builders and home buyers, overconfidence in ever-rising home values, and a fear of missing out of the real estate boom drove the housing market to unsustainable levels of sales and building. Let's look behind the affordability numbers. On this chart, I've revealed the 3 components underpinning the Housing Affordability Index and have adjusted home prices and family income for inflation In the same way, I adjusted construction expenditures. Looking at home prices and income in constant dollars rather than inflated dollars is more informative when looking at trends over a long period of time. We can see that when the housing market started to collapse in 2006, and the realization that a quick recovery was very unlikely sunk in, housing prices and then mortgage rates dropped. This was when affordability started to improve, hitting record levels for 5 consecutive years. During the Great Recession, and for a few years following, all 3 components drifted lower: family income, home prices, and mortgage rates. Due to lower borrowing costs and lower purchase prices, affordability soared, but new housing starts remained depressed. Since 2012, you can see that home prices, the light blue area, have increased much faster than family income, shown as the darker blue area, while mortgage rates hovered around 4%. The improvement in affordability over the past few years has been largely due to the decline in borrowing costs. In 2020, compared to 2019, median home prices were up about 10%, and median family income was up about 7%, while family mortgage rates declined almost 22%. As a result, mortgage payments as a percentage of income declined 2%, resulting in the higher average 2020 Home Affordability Index, which was up 8% from 2019's average. A couple notes about current levels. First, notice that the median home price today is higher than it was at the peak of the housing bubble in 2006, even after adjusting for inflation. Second, be careful to read too much into the median family income levels, which appear higher during the pandemic-induced recession. Job losses were heavily weighted to the lower rungs of wage earners, so the median family income was hit particularly hard. Third, the stimulus payments issued by the federal government in April of 2020 and January of 2021, and another which is going to show up in March of 2021, have artificially boosted annualized monthly income figures. Holding home price and income steady, a 0.5 percentage point increase in mortgage rates drives the affordability index up or down about 10 points. Looking forward, the massive government stimulus payments and unemployment supplements are generating inflation concerns, which in turn are expected to push mortgage rates higher. At the same time, thin home inventories are elevating home values as demand outpaces supply. Expect affordability to turn lower in the coming months, ignoring the impact of the March 2021 stimulus payments, but don't worry too much about affordability's overall impact on housing starts. On this chart, I'm showing the single-family starts in blue and multifamily starts in green. The distinction is important. A single-family home uses about 3 times as much wood as a multifamily unit. The red dashed line reconciles this disparity by converting everything to a single-family equivalent on a rolling 6-month average. During the 2000 to 2006 period, when construction outpaced demand, housing was overbuilt by about 2 million units. During the Great Recession, an underbuild of about 4 to 6 million units occurred, so we're still in a net deficit position today of about 2 million housing units. You can see that single-family starts remain well below the 2006 peak, while multifamily starts are actually higher than they were in the early 2000s. So far this year, total housing starts are up 8% compared to 2020's 1.4 million starts, with the number of single-family starts up 9% and multifamily units up 5%. Forecasters are expecting around 1.5 million starts in all of 2021, flat housing start levels in 2022, and modest increases in 2023, 24, and 25. Long term, the 2 million deficit of home will be slowly replenished as the price gap between new and existing homes narrows and as millennials enter prime home buying age. Gains in construction will be tempered by limited construction labor, a short supply of developed lots, longer construction times, tight construction financing standards, ubiquitous student debt, and by the occasional recession. At the same time as housing starts are improving, you can see in the left-hand chart that the average size of homes have been declining since around 2014. This decline in home size has helped keep building costs lower and tempered lower lumber and panel demand as builders try to offset some increases in cost and attract more first-time home buyers by offering lower-priced, smaller homes. Single-family home size, the blue line, dropped 1% in 2020, and multifamily home size, the red line, averaged 2.4% smaller in 2020. Also on this chart, you can see that the mix of single and multifamily starts, the dashed green line, has improved over the past 5 years. In 2020, the U.S. returned to its long-term average of 67% single-family units, but remain well below the 82% mark averaged during the housing boom of the early 2000s. As I've mentioned a couple times, construction times from start to completion remains elevated, particularly for multifamily unit construction and single-family homes not offered for sale and managed by either a general contractor or by the owner. Extended build times stretch out more expensive construction loans, which adds to the builder's costs and also slows the consumption of building products for any one given start. We talked a lot about rising home prices, and I thought it would be good to show you what's driving that. Here on page 10, we can see how the inventories of existing homes, the red area, and new homes, the blue area, are considerably lower than they were in years past. While inventories in recent years, 2012 through 2019, fell to about half of what they were during the housing boom, inventory levels in 2020 and early 2021 have really nosedived. In the past year alone, February 2021 inventories are 25% lower than just a year ago in February of 2020, with almost all of this decline due to a drop in the number of existing homes up for sale. The red and blue lines on this chart depict how many months of sales are in inventory. In normal times, there are usually 4 to 6 months worth of homes up for sale. In the first couple of months of 2021, there are just 2 months of existing homes on the market today. Existing homeowners are staying in their homes longer, suppressing supply in the face of strong demand, and thus increasing existing home values. This in turn limits existing homeowners' options to purchase replacement homes, creating a vicious cycle. Many repair and remodel projects occur within the first couple years of ownership, so high turnover of existing homes can boost building product demand, while lower turnover can dampen demand. But in the current housing market, the opposite has occurred. Homeowners upgraded and remodeled their current homes rather than sell them and buying a newer or bigger home. Looking forward, rising mortgage rates will price some marginal home buyers out of the market. As demand cools, home price growth will probably slow a bit, if not stall. As the pace of sales ease, inventory should recover, taking some of the pressure off home price. Turning now to product prices, I've graphed the nominal prices for lumber, plywood, and oriented strand board, or OSB, the primary wood-based building products used in residential construction. These charts clearly illustrate the meteoric rise in product prices seen in the last year. This steep price run-up during the pandemic started with a stronger than expected surge in residential improvements, which we saw a few pages back, as much of the public worked and schooled from home and skipped the summer vacation, and as new home construction quickly resumed after the initial stay-at-home orders. This fueled a surge in demand for wood products in the face of limited supply, which in turn drove prices skyrocketing. Supply was constrained by transportation shortages, worker shortages, and lower productivity in the mills due to social distancing and sanitary precautions. A number of OSB facilities also curtailed production in 2020 and into 2021 due to some extended mill shutdowns. Compared to the first quarter of 2020, mill gate prices for plywood in the first quarter of 2021 were 96% higher, almost double. Lumber prices were 144% higher, and OSB prices were 197% higher, almost triple. As more workers become vaccinated, as in-person learning resumes, as the strain on the transportation network subsides, and as federal unemployment subsidies sunset, the labor constraints in mills and in transportation should ease, resulting in added mill shifts, improved productivity, and faster deliveries. Add to this expected lumber capacity additions in the U.S. South in 2021 and some pauses in construction as builders and home buyers postpone or downsize building projects due to high material costs. Together, these factors lead me to expect a substantial moderation in product prices by the end of 2021 and into 2022, as wood product supply and demand get back in balance. While some may view this recent increase in product prices as long overdue and deserved, keep in mind that in the past, high wood product prices have invited more imports from overseas and some substitution of wood by steel and concrete products, which on the whole are not good for the U.S. wood products industry nor the environment. Regionally, product prices have been fairly even, though at times, in some regions, uneven price gains and retreats have caused some temporary dislocations. To be sure, no producing region has been left out of the price bonanza. But while lumber prices have soared, timber prices have lagged. In the Pacific Northwest, we've seen much more modest delivered log price improvements. Regionally, the volume of available timber has been sufficient to meet the slight increase in sawmill demand without forcing log prices higher, despite the rise in product prices. And don't forget the extraordinary fire season across the West in 2020. Normally, we would have expected to see lower log prices given the smaller charred logs being forced onto mills. But with widespread damage to logging equipment and more challenging logging conditions, all during a pandemic and a period of historic wood prices, mills had little incentive to dicker on price. Compared to the first quarter of 2020, delivered log prices in the first quarter of 2021 were up just 18 to 20% for key Pacific Northwest species, compared to 132% for regional lumber prices. While price improvement was welcomed by landowners, a good portion of this increase in delivered log prices were captured by the logger. While all of North America had to deal with the depressed housing sector in the U.S. that lasted more than a decade, the pause in housing starts allowed both the inland and coastal Northwest regions' standing timber inventories to recover. Export markets to Asia also helped West Coast growers find a home for their logs. Today, the supply of standing timber is reasonably well balanced with demand from local mills and importers, helping support regional log prices despite weaker housing. In the U.S. South, it was another year of depressing prices for landowners, made worse by the bounty of riches realized by sawmills. In the South, the surge in plantation acres established 20 to 30 years ago, shorter rotations, and increased plantation yields, and the lack of a meaningful export market have created a surplus of standing saw timber relative to mill consumption, even as sawmill capacity has increased over the past few years. Add to this improved sawmill recoveries, it is little surprise, at least in hindsight, that Southern timber landowners have suffered dismal flat nominal stumpage prices for more than a decade. Compared to the first quarter of 2020, pine stumpage prices were up just 2 to 5% for key grades in the first quarter of 2021, compared to a 162% increase for regional lumber prices. From my vantage point, southern yellow pine sawtimber prices will remain under pressure for an extended period. The combination of plentiful inventory on the stump, slowly improving housing starts, increased plantation productivity, and incremental improvements in mill recoveries will all work against significant gains in southern pine log prices. With this combination of high product prices and flat to slightly higher log prices, mill margins in both the Northwest and the South have skyrocketed. This chart shows that southern mills, in blue, have enjoyed much better gross margins than Northwest mills, in red, over the last decade, and should expect to do so for a few more years. The implication for landowners being that new capital in the sawmill industry will be focused more on the U.S. South than other regions in the U.S. and in Canada. In addition to better margins, southern mills also have the advantage of being closer to the largest end-use markets. More than half of U.S. housing starts are in the southern U.S., giving them a natural freight advantage over other lumber and panel-producing regions of North America. Shifting to timberland values, over the last 20 years, the right-hand chart shows that almost $70 billion of timberland transactions have been consummated in the U.S., 2/3 of which have been acquired by Timberland Investment Management Organizations, or TIMOs, on behalf of institutional buyers such as pension funds and insurance companies. When the TIMO business model was getting started, institutional investors had about a 10-year investment horizon. Today, these investment funds have gotten larger and some are gotten longer and some are open-ended, leading to a less turnover of assets. In terms of the number of acres sold, less than 1 million acres sold in 2020, no doubt impacted by the pandemic and the restrictions it imposed for on-the-ground due diligence and the uncertainty it created in the markets in general. But despite this low level of activity, the lowest in over 20 years, it doesn't appear that timberland values were materially impacted. Because every property sold is unique, it makes year-to-year comparisons of price less meaningful, especially in the Pacific Northwest, where site quality and stocking can vary tremendously. But even so, while timberland values have been uneven, we can see a modest upward trend in nominal prices in each of the major timber-producing regions of the U.S. Here on page 17, I've once again adjusted prices for inflation and have added some linear trend lines to make it easier to see what's going on. You can see that timberland prices in the South and in the Northeast, in real dollar terms, have slightly outpaced inflation, while timberland values in the Pacific Northwest and the Lake States have not. In the South, where, as a region, standing inventory volumes have grown more than 30% over this time period, timberland prices have increased, enabling the South to outpace other regions where productivity gains have been far lower. Again, year-to-year comparisons are tricky due to variances in stocking and site quality between properties sold in any one given year. On the next few pages, I'll be sharing some analysis I've done using data compiled from publicly traded timber-owning companies operating in the U.S. While the trends and performance of public timber companies may be of less interest to you, they may be able to serve as something of a benchmark for performance as you evaluate your own operations. Over the past 6 years, total harvesting volume and timberland ownership by publicly traded timberland companies have been declining, due primarily to a combination of non-strategic land sales and higher and better use land sales. Since the mid-2000s, ownership has declined 19%, while harvest levels have declined 16%. Here on page 19, I've broken out the land sales using the categories reported by these companies. The number of acres sold in 2020 edged past the record level of acres sold in 2008. Most of the acres sold in the past couple of years came from Weyerhaeuser, as it offloaded hundreds of thousands of acres of what it called non-strategic lands, the red bars, in Montana and Southwest Oregon in 2020 and Michigan in 2019. The sales of these lower stocked and lower valued large timberland properties drove the average price per acre lower, as you can see in the red line on the right-hand chart. Also interesting is the steady increase in acres sold and the flat to lower prices for higher and better use, or HBU, land sales, shown here as the blue bars for acres and the blue line for price. The proportion of company lands sold by public timber companies has tripled over the past 15 years, from 0.3% in 2005 through 7 to 0.9% in 2018 to 20. The decline in per acre values for HBU is not surprising, as these companies sell the highest valued HBU first, while hoping for some price appreciation for lands held for the future sales. Clearly, this hasn't happened, with values declining over time as more acres and lower valued lands are offered for sale each succeeding year. Still, these HBU lands are fetching retail values that exceed values for pure timber production, but the premium appears to be dwindling. I would expect this trend to continue for these companies. For the publicly traded timber companies, we can also see on page 20 how their timber operations have performed over the past few years in terms of earnings before interest, taxes, depletion, depreciation, and amortization, or EBITDA. For those not familiar with this financial metric, think of this as cash-only operating income. In the West, EBITDA margins improved in 2020, especially for Potlatch, who has log supply agreements with some local sawmills where the contract prices were indexed to lumber prices rather than market log prices. In the South, EBITDA margins declined for the three largest timber companies in 2020 as log prices drifted lower. In general, EBITDA margins tend to follow the log price charts we saw a few pages back. These charts may serve as a benchmark for your harvesting operations after I have filtered out some of the accounting inconsistencies each company introduces in their investor presentations. So what we've seen is that the fundamentals of the housing market look reasonably strong in the near term. Higher builder confidence, strong single-family and residential improvement construction expenditures, slow but steady improvement in housing starts, all underpinned by good affordability. But at the same time, housing starts face some challenges from the rising cost of homes and home construction, the prospect of rising interest rates, and the potential for a retreat from the surge in home ownership desire and renovations as life gets back to normal following the pandemic. With all of the challenges brought forth by the pandemic on wood products production, we saw how prices skyrocketed over the past year. But what goes up usually comes down, and I expect to see significant moderation on product prices over the course of the next year as the industry gets back to full production, as builders try to reduce costs, and as imports and substitute products capture some market share. For timberland owners, the rise in product prices have not translated into materially higher log prices or revenues in 2020. The West has a better chance of seeing improved log prices in the coming years, but Southern timberland owners should expect a few more years of disappointing log prices. The volume of timberland put up for sale should improve as travel restrictions are eased, but there is always a wild card of the quality and stocking of the land put up for sale that challenges the observer's ability to discern if timberland prices are actually rising or falling. For the public timber companies, revenue generated from the sale of non-strategic lands will surely fall, and the volume of land sold as higher and better use are likely to continue, albeit at flat or lower prices. Timber operating margins are likely to improve in the West as companies shift to less salvage operations, but remain flat in the South as the overhang of an abundance of pine saw timber looms large for a few more years. I appreciate your attention. Hope you found this to be informative and would like to now open the lines for any questions you may have.
Thank you, William, for that presentation. As mentioned, if folks have any questions, comments, they can raise their hand. We can open up your lines. You can also share those questions in the Q&A box by typing them. While we're waiting for folks to think about the questions and raise their hand, William, do you have any comments to add or thoughts?
Sure. The presentation that you just saw was produced early in May, and there have been a few more updates for expenditures during the first quarter of the year. They're up 22% over the prior year. And through April, single family starts were actually higher in March and then fell in the month of April, largely through continued price increases. And what we've seen is that year to date, single family starts are now up 27%, while multifamily starts are essentially flat compared to the first 4 months of 2020. And then there was one other thing that I thought would be useful, was that lumber prices or product prices since just in the past month have all increased 45% since March of 2021. So while the numbers that I presented were pretty huge, they're up almost another, they're up 45% just since the March numbers that were in the presentation. So the increase has gone largely unabated.
Thank you, William, for that update. That actually relates to one of the questions we have in the Q&A box from Charles Sink. The question is, while the wood market is up right now, how sustainable would the prices be? I'm couching this question in relation to taking the time to set up a sale that could catch up with these high prices. Do you have any thoughts on that?
Well, that's assuming that log prices are well aligned with product prices. In the Pacific Northwest, you'll continue to see there's a stronger relationship between product prices and log prices. And in the Northwest, log prices tend to lag the market for product prices by a couple months or a full quarter. So I guess if I were a betting person, I wouldn't gamble and delay putting a stand up for sale, hoping that prices will continue to rise, prices in 2020 were up 18 to 20%, which is, not nothing. And they may rise more. They may rise more in the next 6 months, but it's still a pretty darn good price. So I guess my advice would be go ahead and put it up for sale, but get the next sale ready in the queue for marking when its turn is up.
Great. And then we have a couple of regional questions. The first one is from Don. Are there any additional states besides Washington that provide delivered log prices? And he has a link associated with that in the chat box.
Yeah, so well, in the U.S. South, most the market is generally a stumpage market. There is a service called Timber Mart South that does report both stumpage prices and delivered log prices. And they do that for each state. So, anywhere from Texas to Florida up to Virginia and all points in between. And Forest Economic Advisors does also track log prices by region, so in the Northeast and in the Lake states as well. And they can provide, they've got both stumpage values and delivered log values. So, that's not state specific. Just trying to go through my memory and think if there's any state that does report on a delivered basis other than Washington, and I can't say that one comes to mind.
Your answer is great for one of our other questions, and that actually related to log prices. The question was, you talked primarily about log prices in the Northwest and Southeast. Do you have any data about Lake states delivered log prices? So in your memory, are there any from the Lake states that you can think of? So
there is some publicly available data on log prices in the Lake states, primarily from the state, but they only relate to state sales put up for sale, and it's pretty challenging to measure how that relates to privately held timber sales, especially on a delivered basis. But I think I know the state of Michigan publishes their sale prices, log sale prices, and Wisconsin may do that as well. But again, you can, Forest Economic Advisors or FEA can be a source of information. In the Northeast, there's a company, Forcon, who puts out a monthly or quarterly newsletter, and they have, in that newsletter, they publish hardwood lumber prices and hardwood log prices. I guess that the other source of information that you might be able to tap into is Acadian, in the Northeast would be Acadian Timber. They own about 300,000 acres in Maine. And as part of their financial disclosures, they talk about what log prices are in the state of Maine. So there is some limited information there. And then in the Lake states, and I haven't looked at their financial disclosures lately, but there is a public company, Keweenaw Land Company, that owns timberland in Michigan, and I would imagine that there are some statistics there that talk about log prices as well.
Great, thank you. I noticed a hand was raised and then it went down. So if anybody does want to open up their mics to share any questions or thoughts, please go ahead and raise that hand. Make sure your little hand raise is up next to your name. And we don't currently have any additional question and answers in the boxes. There were some resources shared in the chat. Any other thoughts to share with the group in the time we have, William?
No, that's about it. But I appreciate the questions and I appreciate the opportunity to present to everybody today. And I hope you found it helpful.
Definitely.
Or at least interesting.